What are annuities and why are they relevant in 2025? Annuities are financial products designed to provide a steady stream of income, making them a popular option for retirement planning. Essentially, you pay an insurance company a lump sum or series of payments, and in return, they guarantee regular payouts, either for a set number of years or for the rest of your life. For retirees, this can mean peace of mind, knowing that you'll have a reliable source of income no matter how long you live. In 2025, annuities are especially relevant as people face rising inflation and market uncertainty. With interest rates fluctuating and the stock market being unpredictable, many are looking for safer ways to ensure they don't outlive their savings. Annuities offer that security, but they come with both benefits and drawbacks, which we'll cover in detail. Throughout this video, we'll explore the different types of annuities, the pros and cons, and who might benefit most from these products. Let's start by looking at the various types of annuities available, beginning with fixed, variable, and indexed options. Types of annuities: fixed, variable, and indexed. What's the difference? Fixed annuities, a safe choice for steady income. Fixed annuities offer a guaranteed rate of return, providing stability for those nearing or in retirement. With fixed annuities, the insurance company pays a set amount, regardless of market conditions or the economy. This makes it ideal for those who prioritize security over high returns. While you won't see large gains, you also won't lose money, making it a safer choice for retirees who want reliable income to cover their basic living expenses. It's a trade-off between safety and potential growth, but for many, the peace of mind is worth it. Variable annuities: higher risk, higher reward. Variable annuities take a different approach, offering returns based on the performance of investment options like stocks and bonds. While this can lead to higher returns when the market is strong, there's also the risk of lower or even negative returns if the market dips. With variable annuities, there's no guaranteed income, so they are riskier. However, for those who have a longer investment horizon or already have other stable sources of income, this option might be appealing. It's designed for those willing to take on more risk in hopes of achieving higher rewards over time. Indexed annuities: a balanced approach. Indexed annuities strike a balance between the safety of fixed annuities and the growth potential of variable annuities. Your returns are tied to a stock market index, such as the S&P 500, but they are subject to a cap, limiting how much you can earn in a given period. The upside is that even if the market falls, your principal remains protected, ensuring you won't lose your initial investment. Although your gains are limited, indexed annuities appeal to those seeking some market exposure with reduced risk. It's a practical option for retirees who want to benefit from potential market growth without fully exposing themselves to market downturns. Recap of key differences. Fixed annuities guarantee returns but offer little growth, providing a stable income stream with no risk of loss. Variable annuities, on the other hand, offer the potential for higher returns, though they come with the risk of losing money depending on market performance. Indexed annuities present a middle ground option, offering modest market-linked returns with protection against losing your principal. Each type of annuity comes with different advantages and drawbacks, so your decision will depend on your priorities, whether it's income stability, growth potential, or tolerance for risk. Now that we've covered the types, let's break down how these features translate into the pros and cons of buying an annuity in 2025. Benefits of annuities: guaranteed income, tax deferral, and peace of mind. The benefits of annuities: guaranteed income, tax deferral, and peace of mind. One of the biggest draws of annuities is the promise of guaranteed income. For retirees, knowing they'll receive a steady paycheck for life can be incredibly reassuring, especially when other income sources, like Social Security, might not be enough to cover expenses. With an annuity, you can essentially create your own pension, ensuring that no matter how long you live, you'll never outlive your savings. Tax deferral is another significant advantage. When you invest in an annuity, you won't pay taxes on the money it earns until you start taking withdrawals. This allows your investment to grow over time without the immediate bite of taxes each year. For example, let's say you put $100,000 into an annuity at age 65. Over the next 10 or 15 years, that money can grow, and you won't owe taxes on those gains until you start receiving payments. This can be particularly helpful if you expect to be in a lower tax bracket later in life, allowing you to keep more of your money when you need it most. Perhaps the greatest benefit of annuities is the peace of mind they offer. In today's financial climate, with concerns about market volatility and inflation, the idea of having a guaranteed income stream can be comforting. For instance, a retiree might worry about outliving their retirement savings due to unexpected medical bills or market downturns. An annuity helps eliminate that concern by providing a reliable source of income for as long as you live, regardless of what happens in the markets. While these benefits are appealing, especially for those seeking financial stability in retirement, it's important to also consider the potential drawbacks. Annuities aren't perfect, and understanding both sides will help you make a more informed decision. Let's now explore some of the common concerns and challenges that come with buying an annuity in 2025. The drawbacks: liquidity issues, fees, and limited flexibility. While annuities offer some great benefits, they come with significant drawbacks that can't be ignored. One major issue is liquidity. When you buy an annuity, your money is typically locked up for a set period, often 5 to 10 years or more. If you need to access your funds early, you could face steep surrender charges. For example, if a retiree unexpectedly needs money for medical expenses or an emergency home repair, they may be forced to pay hefty fees to withdraw their own funds. This lack of access can be frustrating, especially for those who value financial flexibility. Another drawback is the high fees associated with many annuities. Insurance companies often charge a variety of fees, including administrative fees, investment management fees, and mortality and expense charges. These fees can quickly add up, eating into your returns over time. For instance, if you're paying 3% annually in fees, that's 3% less you're earning on your investment each year. Over the long term, these costs can significantly reduce the amount of money you have available for retirement. Limited flexibility is another concern. With some annuities, you have little control over how your money is invested, especially with fixed and indexed annuities. Even with variable annuities, you may only be able to choose from a limited selection of funds. This can be frustrating for retirees who want more control over their investment choices or wish to adjust their strategy as market conditions change. Additionally, once you commit to an annuity contract, it's often difficult to make changes without facing penalties or fees. Despite these challenges, annuities may still be a good fit for certain individuals. They can be a useful tool for those who prioritize security and guaranteed income over flexibility and control. So, who exactly benefits most from an annuity in 2025? Let's take a closer look at the types of retirees who might find an annuity to be the right choice for their financial future. Who should consider buying an annuity in 2025? Annuities can be an ideal solution for retirees who are risk-averse and prefer the security of a guaranteed income. If you're someone who doesn't want to worry about stock market fluctuations or other investment risks, a fixed or indexed annuity might provide the peace of mind you need. These products ensure you have a reliable stream of income, which can be especially important if you're concerned about outliving your savings. For retirees without a pension, or those whose Social Security benefits won't cover all their expenses, an annuity can fill that gap by offering a steady paycheck for life. Retirees who value predictability may also benefit from an annuity. Knowing exactly how much income will come in each month, regardless of what happens in the economy, can be reassuring. This is particularly true for those who have basic living expenses, such as housing, food, and healthcare, that need to be covered no matter what. For individuals who aren't comfortable managing their own investments, the simplicity of an annuity can be very appealing. On the other hand, annuities may not be the best fit for those who need liquidity or more control over their money. If you want the flexibility to access your funds without penalty or make adjustments to your investment strategy, an annuity's restrictions could be frustrating. People who prefer to actively manage their investments and have greater say in how their retirement money is allocated may find annuities too limiting. As we look at the financial landscape in 2025, market volatility and low interest rates are influencing many retirees' decisions. Let's explore how these market conditions are impacting whether an annuity might be a smart choice for retirement this year. Evaluating the current market conditions in 2025. Is it the right time? The economic climate in 2025 is playing a big role in whether annuities are a good choice for retirees. One key factor is interest rates. If rates are higher, fixed annuities become more attractive because they offer better returns. In this scenario, retirees looking for guaranteed income might find fixed annuities a solid option, as they'll lock in a higher payout. However, when interest rates are low, fixed annuities provide smaller returns, which could make them less appealing compared to other investment options. Stock market volatility is another consideration. Variable annuities, which are tied to the market, can offer the potential for higher returns, but with that comes greater risk. If the market is unstable, retirees may be hesitant to rely on a variable annuity for their income. Indexed annuities, which track a market index but protect your principal, may appeal to those who want some market exposure without the full risk of loss. But in a volatile market, even indexed annuities can be limited in how much they allow you to earn, given their caps on gains. Inflation is also a major concern in 2025. As the cost of living rises, retirees need their income to keep pace. Fixed annuities may not be the best solution in an inflationary environment, since their payments remain the same over time, losing purchasing power. Variable or indexed annuities, on the other hand, have the potential to grow with inflation, though there's no guarantee. Next, let's compare fixed annuities with another popular low-risk investment, bonds. Both offer stability, but there are key differences to consider when deciding which option is right for you. Fixed annuities versus bonds. Which is better for retirees? Fixed annuities and bonds both offer retirees a sense of safety and predictability, but they work in slightly different ways. With a fixed annuity, you're guaranteed a steady stream of income for a set period, or even for life, depending on your contract. This can provide peace of mind for those who don't want to worry about market fluctuations. However, fixed annuities usually lock up your money for several years, and accessing it early often comes with penalties. Bonds, on the other hand, pay regular interest but allow more flexibility. While bonds are also considered a low-risk investment, they don't offer the same lifetime income guarantee as a fixed annuity. Bonds can be sold if you need access to your money, though this might be at a loss if interest rates have risen since you purchased them. The predictability of income from bonds depends on the type you choose, but there's still a level of uncertainty compared to an annuity. For retirees, combining both fixed annuities and bonds can be a smart strategy. The annuity provides guaranteed income, while the bonds offer liquidity and some growth potential. This blend can offer both stability and flexibility, helping balance income security with the ability to access funds when needed. When shopping for an annuity, though, it's important to weigh several factors carefully. The type of annuity, fees, and your long-term goals should all play a role in your decision. Let's take a closer look at how to navigate these choices. How to shop for an annuity. Key factors to consider before buying. When retirees start shopping for an annuity, there are several important things to keep in mind. First, it's crucial to understand the terms of the annuity you're considering. Annuities can come with different payout options, such as lifetime income or payments for a set number of years. Make sure you know how and when you'll receive your payments, as well as whether the annuity offers inflation protection, which can be critical in maintaining your purchasing power over time. Another key factor is comparing providers. Not all annuities are created equal, and the terms, fees, and payout rates can vary significantly between insurance companies. Taking the time to shop around and get quotes from different providers can help you find the best deal. Look closely at the fees as well, since high fees can eat into your returns and reduce the overall benefit of the annuity. Pay attention to surrender charges, administrative costs, and any other expenses that could affect your payout. It's also a good idea to consult with a financial advisor before making a decision. An experienced advisor can help you weigh the pros and cons of different annuity products and determine which one fits best with your retirement goals. They can also help you avoid common pitfalls, like choosing an annuity that locks you into terms that may not suit your long-term needs. Next, let's look at some real-life examples to see how annuities work in different situations. These scenarios will highlight the ways retirees can benefit from, or potentially be frustrated by, their annuity choices. Real-life examples. Annuities in action for different types of retirees. Let's look at how annuities have played out in real life. Take Joan, for example. She retired at 65 with a modest savings, but was worried about outliving her money. Joan purchased a fixed annuity that guaranteed her a steady monthly income for life. This decision gave her peace of mind, knowing that no matter what happened with the markets, she'd always have enough to cover her basic expenses. For Joan, the stability of a fixed annuity was a perfect fit, allowing her to enjoy retirement without the stress of managing investments. Now consider Tom, who opted for a variable annuity in his mid-50s. He wanted the potential for higher returns and was comfortable with some risk. Initially, the stock market performed well, and Tom saw his annuity grow. But during a market downturn, his payouts dropped significantly, leaving him with less income than he expected. While Tom had other sources of income, the volatility of the variable annuity showed him that it wasn't the best choice for someone relying heavily on it for retirement funds. Then there's Lisa, who purchased an indexed annuity. She liked the idea of benefiting from market growth without risking her principal. Over the years, her returns were moderate, but she appreciated the balance between safety and potential gain. However, when the market surged, Lisa was frustrated by the cap on her earnings. Though she didn't lose money, she realized her gains were limited compared to what she might have earned with a different investment strategy. These stories highlight the different outcomes retirees can experience with annuities. As we've seen, annuities can provide valuable income security, but they also come with certain risks and limitations. In our final section, let's recap the pros and cons of buying an annuity in 2025 to help you make an informed decision. The pros and cons recap. Is an annuity right for you? Let's quickly recap the key points to consider when deciding if an annuity is right for you. Pros. Guaranteed income. Provides steady payments for life, offering peace of mind for those worried about outliving their savings. Tax deferral. Your investment grows tax-free until you start receiving payments, potentially maximizing your returns. Security. Fixed and indexed annuities protect your principal, making them a safe choice in uncertain markets. Cons. Liquidity issues. Annuities lock up your money, and early withdrawals often come with steep penalties. High fees. Some annuities come with significant fees, which can reduce your overall returns. Limited flexibility. Once you commit to an annuity, changing the terms or accessing your funds can be difficult. When deciding, think about your financial goals, how much risk you're comfortable with, and whether you need flexibility or guaranteed income. In closing, annuities can be a great option for some retirees, but may not fit everyone's needs. It's important to make an informed decision that aligns with your personal circumstances. Closing thoughts. Making an informed decision about annuities in 2025. Choosing whether to buy an annuity is a big decision, and it's important to take your time. Thoroughly research your options, compare providers, and understand the terms of any annuity you're considering. This isn't a decision to rush. Each retiree's situation is different, and what works for someone else might not be the right choice for you. Consulting a financial advisor can help ensure you make a choice that aligns with your goals and gives you the security or flexibility you need in retirement. If you found this information helpful, be sure to subscribe for more content tailored to older adults looking to navigate their financial future with confidence. We'll continue to bring you valuable tips and insights to help you make informed decisions.